Hello, I'm Tai Hui, the Chief Market Strategist for Asia Pacific from JP Morgan Asset Management, and welcome to this video discussing our asset allocation views from our fourth quarter 2020 Guide to the Markets Asia. The risk assets such as equities and corporate bonds have delivered strong returns in the past 6 months. However, the rally in equities has been dominated by technology and defensive sectors. Valuations in corporate credits have also returned to their long-term average. Zero return from cash means Asian investors should remain invested. We would expect more modest return from risk assets until the next stage of recovery comes. This would require solutions to the pandemic, such as vaccines or more effective tests. Aggressive fiscal and monetary policies have helped to boost investor sentiment on equities. We expect these policies to stay supportive, but unlikely to be expanded further from the current level. Meanwhile, a significant share of the rally comes from the tech and defensive sectors. If we do get a solution to the pandemic, such as a vaccine, then we could see market rotating into sectors that have lagged in this rally, such as retail and industrials. We also think that the conclusion of the US elections in early November, regardless of the results, could bring more clarity to the US policy outlook. We do expect developed market government bond yields to rise significantly since inflationary pressure is low and central banks cannot afford to allow interest rates to rise. But the low yield in these government bonds do not offer sufficient return to investors. This is likely to push investors to take on more credit risks, including high-yield corporate debt and emerging market fixed income. Sectors with wider credit spreads because of the pandemic could see more upside potential if a pandemic solution is developed. We expect the US dollar to depreciate more in the medium term in the next 1 to 2 years because US dollar interest rates have fallen towards the levels similar to other developed markets. Improvements in global growth may generally be seen as not too supportive for the US dollar as well. Risk assets such as equities and corporate credits may benefit from a weaker dollar. In particular, Asia and emerging markets thrive in a weak dollar environment as it attracts capital flows. The improvement in global trades also benefit Asian corporate earnings, supporting its equity markets. So to summarize, we are waiting patiently for a solution to the pandemic to bring us to the next stage of economic recovery. There is still a lot of uncertainties regarding when this would occur, but we think investors should at least have a plan to invest into this next stage of recovery. This includes a more diversified allocation in global equities and corporate credits. Asian equities and fixed income comparatively are in a good position when they are sensitive towards the global economy. A weaker US dollar could also help to boost return for Asian assets. Thanks for watching. If you want to get a copy of the latest Guide to the Markets Asia, please reach out to your JP Morgan Asset Management representatives.